So now we've taken a look at just what the economy means at an individual level. We've also taken a look at what it means at the government level. But one of the other things that has been pinpointed as leading us to the economic crisis we're in today is the interest rate cap, which ideally was supposed to democratize access to credit and make it cheaper for you and I and other people running small businesses, to make it easier for them to access money. But that has not been the case. So what has been the role of the interest rate cap in the economic crisis that we find ourselves in now? I explain here. So let us start off with where it all began. At the beginning, this is in 2016. If you remember, this was a bill that was put there by Jude Njomo, who's a member of Parliament, a member of National Assembly. And this is the year that the interest rate cap law came into effect. What it essentially meant to do was to put a cap on the lending rates. Apparently, banks had gone rogue and were charging a higher amount and was supposed to make it cheaper. So they capped it at 4% above the central bank lending rate. Did it have the desired outcome is now the question that a lot of people are grappling with, considering the fact that the president sent back a memorandum to Parliament seeking the revision of this. The Finance and Planning Committee has made a recommendation to remove this interest rate cap. It is yet to be decided by Parliament. But a lot of people say that what it did was that it increased domestic borrowing. So before I explain all of that, this is where we are with domestic borrowing, and I'll explain what all these figures mean. Well, as of 2019, the government has borrowed domestically, that is from banks, local banks, to the tune of 310 billion shillings. That is in the year 2019 alone. Now, if you want to take a look at that domestic debt, which again is the government borrowing locally, this is not Eurobond, this is not loans that are being gotten from outside like China. So where are we with the domestic debt? Well, in 2013, when President Uhuru Kenyatta came into office, the domestic debt was at 981 billion shillings. Fast forward to 6 years later, in March of this year, it tripled to 2.7 trillion shillings. This is significant because when the government is borrowing locally, it means banks would prefer government to you and I. And I'll tell you just what this means and why it is significant. Now, if you want to take it specifically to the interest rate cap, which is the purpose of our explainer tonight, in September 2016, when the interest rate cap came into effect, the domestic debt, this is the amount of money that the government was borrowing locally from local organizations, was at 1.18 trillion. It went up about 1.6 to 2.7 trillion shillings in the time that the interest rate cap has been in effect. So what does this all mean? What do all these numbers mean, and what does the interest rate cap mean? So because the banks were not going to get as much profit from lending to you and small businesses, they essentially were more reluctant to lend to people like you and I. And so they preferred to actually do business with government and lend to government and invest in government bonds. This is why you are seeing that increase that we had talked about earlier with the numbers that you saw, increase in terms of domestic debt. So banks don't want to lend to SMEs, to you, to small businesses. They'd rather work with government. What effect does that have? Well, for one, there is an increase in the domestic debt. But most importantly, what it means is if government and banks work closely together, the banks consider you and I high risk. That means that small companies are starved of credit. They go to the banks, they're either not getting it or they're getting it at a much higher rate, or the stipulations are much higher. And when companies are not getting access to credit, what is happening? Their obligations are not being met, and they have to face some serious challenges like shutting down. In fact, just this year alone, according to the Registrar of Companies, between the months of March and August, 388 companies were closed down, with the highest number being seen this year in March, where 103 companies were shut down in just 1 month alone. So what does this all mean? Jobs are being lost. Companies are shutting down because they're unable to meet their commitments. When they go to the banks would rather work with government because of the interest rate cap, which they don't see profitable to lend to you and I and small businesses. Jobs are being lost. In fact, if you took a look at all of these institutions that have formally announced retrenchments, it's up to 4,800, 4,900 jobs that have been lost. And that's from companies that are publicly declaring it. There's a host of all of those other small companies, like those 388, that perhaps employ 1 person, 2 people, 5 people, 10 people. They're shutting down as well. And remember, that is the majority of the organizations. And those are the ones that are hiring the most people at a lower level. So this has then a spiral effect, because when jobs are being lost, KRA suffers. Why? Because all of these people who do not have jobs anymore are not paying payee. And therefore, KRA is not able to meet its targets. And so if you see, this is a vicious cycle. And that is why the President, CBK and Treasury say they were against the interest rate cap in the first place. Will Parliament then repeal this and say perhaps the move to more expensive loans? Will it have a short-term, mid-term or long-term effect? But this is what the interest rate cap is doing to the economy right now, starving you and I of credit, which means we cannot do development at a personal level. Companies are not growing. Jobs are being lost. We wait to see what Parliament does with this. That's our explainer tonight.